Hello there. My name is Teddy. I am not a financial advisor, and this is not financial advice. Today, in this quick, short, simple video, I'm going to explain what stock options are and the fundamental basics that make them and the underlying assets. Have you ever looked at stock options trading and felt like you were reading a different language? Today, we're going to break down one of the most important rules you need to know, especially if you're interested in big name stocks on the NASDAQ. But before we get to that big rule, let's really understand what we're trading. What exactly are call and put options? At its core, an options contract is a deal between a buyer and a seller. It is a contract. It gives the buyer the right, but not the obligation, to do something with the stock. Think of it like a coupon or a deposit on something you might want to buy later. You pay a small fee now to lock in the price for the future. In the world of options, this fee is called the premium. Now, let's break down what options are in two types: calls and puts. Now, let's first talk about call options. Call options are what you want to think of when you believe a stock's price is going to go up. Think of call options as the right to buy. A call option gives you the right to buy a stock at a specific price for a specific period of time. The agreed upon price is called the strike price. Now let's use an example. Imagine Apple stock, which trades on the NASDAQ, is currently trading at $252 per share. You think some great news is coming out and the stock is going to soar in the next month, so you buy a call option. You buy a call option with a strike price of $275 that expires in 30 days. This contract allows you to buy the stock Apple at $275 per share. The cost of this contract, or the premium, is $1.38. This is the fee you pay to lock in the price of the right you want to buy Apple at $275. Essentially, you're paying a premium of $1.38 for this contract, which allows you to buy Apple at $275 per share. Now, let's say you're right. In 2 weeks, Apple stock shoots up to $285 per contract share. Because of your contract, you still have the right to buy in at your locked-in price of $275 per share. Even though it's trading for much more, you're in a winning position. Because of this, the intrinsic value of the premium of the contract increases as well. This is because you're able to buy the stock Apple at $275, which is lower than its market price. That causes the intrinsic value of these contracts to increase along with it. Now, let's take a look at put options. This is what you want to buy when you think a stock's price is going to go down. Think put options, the right to sell. A put option gives you the right to sell a stock at a specific strike price before the expiration date. Now, let's use Apple once more. Let's say Apple is trading at $252 per share, and you're worried about new competition and think the stock's price is going to take a hit in the next month. So, you buy a put option. You buy a put with a strike price of $240 per share that expires in a month. You pay a premium of $2.44 for the right to buy this contract. And again, you were right. Apple stock falls to $235 per share, and while everyone else is stuck with a stock that's worth $235, your option put gives you the right to sell at a much higher locked-in price of $240. That's a huge advantage. You have the locked-in ability to sell the contract at a higher price than what it is currently trading on at the market. This is where the intrinsic value of the contract comes from. This causes the intrinsic value of the premium to increase, and this is how it increases in price. Okay, so now we understand what calls and puts are. Now, there is a crucial piece of information that we're missing here. It's called the 100 share rule. When you're looking at options on any company on the NASDAQ, a single options contract doesn't represent one share of the stock. It always represents 100 shares. Think of it like buying a carton of eggs. In the options world, you're always trading a bundle of 100. Now, let's go back to that example that we talked about. Because this contract is allowing you to buy one share at one price, this premium only reflects on one share. So, because these contracts are always in bundles of 100, the cost of this contract is not really $2.44, but rather it's $244. Let's go back to the other contract example. With this, you're not trading at $1.38, because it's not just one, it's 100 contracts or 100 shares. You're now trading at this contract is $138. Now, let's take a look at a real world example of this. We're going to go over to Robinhood and take a look at some contracts. So, look at this $270 contract. Let's say I want to buy it. Right now, it's trading at 1.38. That does not accurately represent the bid and the ask. Now, you see it says that there's 100 shares each. So, realistically, if we want to buy this contract at 1.38, we're going to pay an estimated cost of $138. Now, let's go take a look at that put example that we were talking about. That put example is 2.44. If we wanted to buy one contract, which is representing of 100 shares each, we're actually paying $244 per contract. This rule of 100s is really important to note whenever you're buying and selling contracts.